Good afternoon, traders. This is Christian Farmer. It's Tribeca Trade Group, and this is your end of day market recap for Friday, the 23rd of May. Happy Friday, everybody. Get ready for the long weekend. Hope everybody's doing something fun, getting away from the screens for a bit for the long weekend. Just wanted to add that too. I'll start the video off that way. Always good to get some time away from the screens, whether it's taking a half day, a full day, or taking a week off. Also making sure that you get up at some point in the day, go for a walk, go for a stroll. Why do I say that? Because all of that like gives you perspective. It gives you gives your brain a break from the screens. I mean, it is, I sometimes will joke around in the trading room because that's what I've always done in terms of, even when I was an institutional trader. I worked with a very cohesive, tight group of traders on an institutional trading desk. But from time to time, we would spend time and joke around a little bit. And you would just have to do that because it just kind of helps a little bit. It breaks up looking at the screens all day long, numbers, charts. All kinds of things like that. So getting away from the screens is actually a very good thing. Why do I bring that up? Because sometimes I see people whenever there's a day off, they complain that the market's closed. It's actually like one of the best things for you is to get some perspective. And in any event, I hope that you're doing something fun for the weekend. Let's get to the risk disclaimer. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving any advice or recommendations. Everything that we're going through is for information purposes only. So once again, I feel like this has been the theme of the week is that you have some good in this market and some bad, and definitely some trading opportunities throughout. I will recap today really quickly, and then I will recap this week's performance, as I always do on Friday. But if you look at just at your screen, a lot of things moving up. You've got uranium stocks were up huge on the White House announcement that they're looking into nuclear power, and believe that they signed it like an executive order. So that's something that's been talked about for a bit, that they are going to explore nuclear power. So today was kind of the news that that was done, and uranium stocks did extremely well, up 11.6%. So the likes of Oklo, SMR, I think it's NNE is the other one, up huge. I might as well just go over a couple of these. I do like to, even though I didn't have any Oklo on, but you could see that we went right up to that virgin point of control, and a little bit of rejection there. I think SMR did better, but did not close on the highs. I mean, again, these are monster moves, up 19% for the day. And then, of course, the other, like the power generation companies, did pretty well today too. I mean, although this was just another like regular day for GEV. Now it was up more pre-market because I took profits, and I took profits at I think it was 468 this morning. I didn't get the high point, but this is a name that I've been long for a while. And if you go through this group, we know that GEV and Energy have been the market leaders of this group. Very, very strong group. PWR also had a nice day today, up 1.4%. A couple other ones, VST starting to turn the corner. Let's see if that could get to the VPOC. Also CEG, which got out of this sideways consolidation, and the VPOC up here is about 5.7%. That's at 314.60. So yesterday, it was the quantum names. Today, it was the uranium and nuclear names. So it does feel like there are themes to play that have been going on. So, the solar and clean energy group also did very well today. I thought that that was an overreaction. They all got clobbered. Like, yeah, this has just been the story for solar stock. So it seems like solar stocks just they're in a downtrend. They bounce like anything could bounce in a downtrend, but then they resume their downtrend. But I thought specifically yesterday was an overreaction because we don't know. They sold off on this like budget deal that's went through the House, but odds are it's going to need to be modified by the time if it does get passed through the Senate. So hence the relief bounce today. Gold did pretty good today. Gold, I took off my long trade. I had talked about in my Substack midday post, I had talked about specifically how we saw some gold buying, GLD buying. That was, I believe, on Tuesday, was a pretty large call spread in GLD. So I did take this trade off. I was just in this for a short-term move, which was right around this virgin point of control up here. So I took this off right around 309 today. But regardless, the gold's call positioning kind of helped. Here is the post that I put together. I was talking about how, first of all, GLD was in a nice place. It was right on the 50-day moving average, which I thought was a good place to buy the dip in GLD. And this is often how I take a trade. Sometimes I see if I see option activity, we see so much option activity on the tape. That a good portion of it doesn't work. Some of it does work. So if I see a trade like that on the tape, like where there's 16,000 contracts that went up for a call spread, and it's a large trade, $4.6 million. And if it meshes with my technical system, I will often put the trade on. So I added along, and this was nice. This was a nice trade in GLD from earlier in the week. And nice performance for the week. I think gold for the week finished up 5.3%. So definitely some outperformance there. Let's get over to the indices. So I want to talk a little bit about what we saw this week, and here's I'll bring back that performance up for the week. S&P fell 2.5% for the week. The diamonds, so Dow Jones Industrial Average, fell 2.4%. Small caps underperformed, and the Qs were right in line with the S&P, down 2.4%. International developed markets outperformed. EEM was flat for the week, so relative outperformance there. Bonds, which I heard a whole hell of a lot about this week, were down 2%. And there's that gold up 5.3%. UUP, the dollar was down this week. Sorry, let me put this in the right thing. Both growth and value were both down this week, almost equally. Kind of interesting there. No major outperformance there. So what I was going to just talk about was, a couple of the adjustments that I have been talking about all week long. When the market changes its character. So what changed this week, or what were some of the dynamics or the characteristics that changed this week? I mean, so these are all things, if you watch my videos this week, or if you're in the Tribeca Trade Group trading room, you know that I stressed these and talked about them as they become as they kind of arose. So SPY Qs fell below the 5-day moving average. Why is that important? Well, let's just recap, because I think it's probably one of the most important ones on the list of things that change this way. Well, once we start to lose the upside momentum, there's a number of things that could happen. Number one, we could find some support here, and we could potentially bounce back at the 200-day moving average. In fact, we had a nice bounce today. Did not close on the highs again today, and again, these closes now have gotten from really strong to really weak. So that's another I didn't list that in my tweet earlier, but it's definitely one of the characteristic changes too, is that for the last couple of weeks we've seen these strong closes. You could see these, where the candles close right on the highs of the day. The last few days, in fact, I think it's the 3 days in a row, we closed, very weak, and especially like the last 15 minutes yesterday and today. But once we slip below the 5-day moving average, I was making this point. We do Q&A on Fridays. I was talking about how technicals are not predictive, right? And I know sometimes this gets lost. Social media is very good in terms of, it's very good and it's very bad. You can compare and contrast on your own, but there's very good follows who share information, right, and are pretty objective. Those are the people that I like to follow. When they see something different in the market, they point it out and they tweet it out. Some of the worst follows, I think, are the ones that are always making predictions. Some of them make obvious predictions, and I think it's, for some of these folks, it's like a self-confidence issue, right? Like, they're going to tell you, like, oh, the market's definitely going to be higher in a year. Well, yeah, I mean, those are obvious statements to make. Or they'll tell you, like, this stock is going to rip higher, right? And no one really knows that. This is all salesmanship. Um, because technicals, and if you're following people that are using technicals and they are making predictions using technicals, you should know, even though these folks sound confident, that's a bunch of BS. Right? Technicals are going to give you rules, right? They're going to give you rules to be long versus short. The technicals that I use, I think are important because they tell me where there's significant support resistance. They tell me where there's overhead supply, but they're not predictive, right? And I get questions all the time. It's like, what do you think this stock's going to do? Like, do you think it's going to rip higher, right? As they say on Twitter. Um, I'm like, no, I don't know. Like, here's your place to go long and here's your place to go short. So why am I talking about this now? Why am I bringing this up? So these are the things that we know. When we break below the 5-day moving average, the upside momentum is gone, right? And now it's as we're trickling down here, right? The bears are now more in control. And this could flip-flop back and forth, but it could also be something like this, right? So for example, if you trimmed here and if you maybe you sold more at the passing of the 50-day moving average, you avoided the majority of this, right? That's a quick, easy rule to have, and it's a keep it simple type rule. So did I know that once we broke the 5 period moving average here, that we were going to go all the way down to here before we at least got back above it for a bounce? No, I don't. And again, you don't know. But once we break here, you make adjustments because we don't know if this is going to be support. We don't know if this is going to be support or down here could be support. You don't know any of that, right? But you make adjustments as you go along. Now, this doesn't normally happen. I would also add that these corrections like this, they don't usually happen. We know that we usually get 1 to 2 corrections a year on average, where we fall somewhere in the neighborhood of 5 to 10%, right? We know that we're going to get those. Are they easy to predict? No, absolutely not. But if you have rules in place, you can alleviate and you can that's the beauty of technical analysis. Not that it's predictive, is that you're setting rules as you go along, and you should be limiting your losses if you're following appropriately. Now, it all depends on your threshold, by the way, right? And I talked about in yesterday's video different time frames. There's different time frames for depending on what time frame you trade. Some of you maybe just day traders, some short-term swing traders, 3 to 5 days, some long-term swing traders, and some long-term holders. So a 5-day moving average is probably not right for a long-term swing trader or for a long-term investor. It is the five-day moving average is a short-term moving average, but for someone who's trading short-term, then it's very good. Now, you could also be more tolerant and say, hey, I'm going to use the 20-day moving average, which you could see is lining up with the 50-day moving average. So that could be your line in the sand. And that's perfectly fine as well if you're looking, if you're accepting a bit of a drawdown before you get there, right? All things as long as you establish these rules before you enter the game, it's okay. Small drawdowns are not a problem, right? But what you should not be doing is, okay, well, I watched it go by the 5-day moving average. That's not good. Uh, Price is going to the 200-day moving average, and then it goes past the 200-day moving average. You're like, that's not good. But what's my next support? Right? That's not really how you should be trading, right? That's just basically referencing things as price goes by it. So, um, that was the one thing. And I made adjustments, once we broke on Wednesday. Again, we hung in there on Tuesday. Wednesday, once we broke, I took off a bunch of trades, right? So when and by the way, this was not the only thing. If we go back to my list here, breadth also started to weaken, right? And you could see this. You could look at a couple different things to notice the breadth. You could look at the advanced decline line. You could look at the NYSE NASI, which comes out. I look at that at the end of the day, which is also weakened, right? We talked about that yesterday in the trading room yesterday morning, that the NYSE and the NASI line and the McClellan Summation Index both started to move down. Did not have a big move down, but definitely off the upward trajectory. And then 4-week new highs versus new lows. we started to see the new highs contract right around the same time, and new lows began to perk up. And you could see that that's something that I do put out in Substack. You could see that this was the second day that we saw the new lows much, more than the new highs. And you could see that here, by the way, too. Here's see if I can, it's not going to zoom in here, so you're going to have to squint. But you could see how, as the market went up, look at how the new highs contracted. Right. So that's usually not something pretty good, and went basically down to nothing. Right. And the new lows are also increasing. Again, they're not by a huge margin, but it's enough to kind of take us down a little bit. Right. And and that may have, eaten away at your P&L a little bit this week. Right. So it takes a long time to kind of go through this. But I do the illustration purposes for a reason, so that you can understand how you could use a 5-day moving average, or use a 20-day moving average, again, depending on what your level of drawdown, what you're okay with having. But have to establish those rules before you enter the game. What else so here's what is a little bit difficult, because you're still seeing these pockets of strength. Like I said, today it was uranium. The gold miners had a good week. But that's really it. Quantum stocks. Now, this quantum ETF is not a great proxy for the group, as I talked about that yesterday, but you could see the majority of groups were down. Now, if we could stabilize here, will this be a good buying opportunity? Absolutely, it could be. But things have to kind of stabilize. We've seen this now a couple days where buyers have come in, but they haven't been able to kind of cross the finish line, right? And that's what I'm referring to, is just the end, a little bit of end of day move, right? We're also stalling once we hit upside resistance. If we look at these 1-hour charts, right? I also wanted to note one other thing, and I'm not trying to ruin anybody's weekend with this stuff, but we've stayed above. So again, I also use the 1-hour charts for all this. All this should give you more like weight of the evidence that something might be a little bit miss here. And this is this black line is the 200-day moving average when I'm using the daily chart, but it's just the 200 period moving average. But it acts as a really good trend line. Some folks like anchor VWAPs, you could use those too, but they're gonna give you like very similar signals. So here is your break higher above the 200 period moving average. This was all the way back towards the end of April. Notice that price stayed above here all the way until now. So you've got a change of character. We broke through this. We bounced back today, but we didn't go too far. So a little bit of a rejection there, and prices below this. So again, that's telling you that there's a little bit of a problem here in the short term. Same thing with the S&P on the 1-hour chart. Here's where we broke above the 200 period moving average, right? Here's where, and here's now we're breaking through it. Now, can I tell you where we're going to go next here? No, because I don't have a crystal ball or a time machine. And if you have two of those, that's great. So for now, what I would say is we're losing this short-term trend, or we lost the short-term trend. Why not wait until price gets back above there, right? Or you could go out on your own and make some prediction like social media does too, and then you could flex your muscles with that 50% chance that you're going to be right. But this is what this is what we have, right? This is what we're dealing with. Folks on social media like to make predictions. Other folks like to be objective and take the information and make adjustments as they see it. So why is it? So I'm going to come back to this, right? With this move today that we saw with the gap down on headlines, right? It's if you saw the warning signs this week, when you get to today and the market opens up lower, right? Instead of playing defense, right, you could play offense, right? Today was saying, hey, I'm going to take advantage of this dip and I'm going to go into some things and I'm going to buy the dip, right? It's a bit harder to do that when you've got a lot of positions on and you've got to manage those positions versus look at the road ahead and look at the opportunities in front of you. It's a probably the most important concept that I'm going over in this video is that you want to get on the right side of the ball, right? You want to, so when you're playing defense and you're worried about, you know, a few positions that are deep in the red, you're not going to be focused on the new opportunities that are in front of you. It takes a while to learn this, and that's why I'm stressing it in this video, is to try to get on the right side of the ball. If you make the adjustments early on, when you first get the warning signals, you're going to be much better off if there's more of a market dip than just for the day. All right, I think that's pretty much all I wanted to cover. In terms of performance, just a few charts that I'll bring up, some of which maybe I talked about in my midday note. Again, make sure that you're signed up for my midday note. I provide a lot of these things as in my midday note, which I try to make it very easy for you to get through. I try to make it like under a couple minutes. And I include an audio note. So that takes a couple minutes. That takes 3 minutes. So if you want, you can listen to that. You can listen to my perspective on what I'm seeing for the day, where I see relative strength, weakness. Let's talk about a couple of these things. So one of the things that's really stood out to me is how strong cyber stocks have been. Even with Palo Alto reporting, take a look. This is CIBR versus SPY. So cyber stocks versus SPY. What do you see on your screen? Right? You see that the cyber stocks have been crushing it in terms of the overall market, right? Once you put the cyber in the numerator, SPY in the denominator, you can see that you've got a really strong trend here. So that's one of the strongest areas of the market. A few stocks look pretty good. I mean, these are stretched. These have gone up a lot. The ZS, the RBRK. Right, continue to go high, up another 1.3%. Cyber acted pretty decently today, even though it hit a VPOC up here. So CrowdStrike is going to report earnings in about a week and a half. I went long this name. I've been watching it for a while. Let's see if it wants to break out and maybe run into that earnings report. Right, Uber. I know many of you seem to really like this company. I don't really get why, but that's okay. It doesn't matter. Right, from a technical standpoint, this is a nice check back. Right? So you could go long here versus the 20-day moving average. And then if it breaks the 20-day moving average, what do you do? Do you ask me and say, geez, do you think it's going to go back above the 20-day moving average? Well, I don't have a clue, but I know that if you went long, that's your place that you would probably should get out of the trade, right? But it may be set up for a bounce here. Volume, I would like to see a little bit of the volume chilling out here a little bit to show that the selling is done. So I don't know. And again, you could also wait for it to turn the corner. A few other names too that I was looking at today. Carvana, right? Also, bull flag. May take a little bit more time, but is trying to lean higher. And you got a VPOC up there. So a few other names that I'm looking at too. I want to keep the video short. I want to get you to your weekend. And as always, if you want to hear me more from me, or if you like this analysis, sign up for a trial at tribecatradegroup.com. You could get 5 days free if you've never tried it before. That's coupon code TTG new. And make sure that you're signed up for the Substack, at least the free version. The paid version is only 20 bucks. I think everybody could afford that, especially if you're trading. I want to go over something really quick and one more rant, right? I spend personally, most traders, they spend a lot, they spend a good amount of money making sure that they're prepared for the market, right? And that doesn't mean signing up for free Twitter, right? Everyone, in my opinion, and again, it doesn't have to be my service, but you should be investing in something like if you're serious about trading and you're not really spending anything on getting the tools that you need, first of all, I pay for Bloomberg, right? Which is way too expensive. So you don't have to pay for Bloomberg. But at least you should have some tools like FinViz, right? You could pay for a subscription for FinViz. That's very cheap. It allows you, these things allow you to be more efficient, right? And scan for stocks, right? So that's a good one. If you like option flow, like I use Trade Alert, right? I mean, that's something that allows me to kind of see some of the signals, like I mentioned with GLD, even though I know a lot of the signals don't, a lot of the option activity doesn't work. But it does give me it does give me an edge in trying to find some new ideas and where their momentum might be. But the point is, make sure that you sign up for things. I see a lot of people once they're introduced to, once they start and they're getting more serious about this, they're afraid to spend any money. right? You've got to spend some money to be able to get yourself to a place where, you know, you have the right tools to do things. So again, you don't have to join my join my room, which what I try to do is give investors edge and give them information and give them things like the technical tools and show traders how to use the technicals in an appropriate way. And I try to provide a lot of education like that, as well as the information behind my trades. But there's other things that you could do, but make sure you're doing that. And making sure you're investing in yourself to give yourself a little bit of an edge. All right, that's it. Have a great weekend, guys.